Well, good morning, ladies and gentlemen. Welcome to the first panel. As you have heard from the chairman and the financial secretary, there's really a very large spectrum of issues in terms of financial regulation that's at the moment affecting Hong Kong. This first panel, which takes stock of what regulation has been and what challenges are before regulators, the market. I'm not going to repeat what the financial secretary and the chairman has said. You've heard them. And therefore, we'll come straight to the panel. Before I introduce members of the panel, I'd like you to know that we're going to afford you the maximum opportunity to raise questions, because this is the whole idea of the panel is to really encourage dialogue and to hear from you, members of the market and alumni of the SFC. I see many members of the alumni here, to air their views, and so that we can all benefit from this exchange. There's an app, as you know, where you are able to input your questions, but at the end of the day, if your app doesn't work or you can't make it to work, you just write out your questions on a piece of paper and hand it to a member of staff who's around you. That's sort of default methodology. And we're going to afford you as much opportunity as possible. So I'd like to just introduce you to members of the panel. Sitting next to me, that's Andrew Weir. Andrew needs no introduction. He's the chair of the listing committee of the stock exchange. And then Ken Hitchner. Ken is the chairman of Goldman Sachs, ex-Japan, of Asia. And then Yin Ke, who is the chairman of CITIC Securities. I have to declare an interest. I sit on his holding company board, but I assure you I'm not going to go easy on him if there are difficult questions for him. Then there's Graham Turl, who's general counsel of BlackRock Asia. He's also the chair of the Investment Association of Hong Kong. And of course, Ashley, whom everybody knows and needs no introduction. Now, I'm going to start with Ashley, who will just give us a brief introduction. Each member of the panel has about 5 minutes just to say what they wish to say as an opening set of remarks, and then we'll go into a discussion. Ashley.
Okay, well, thank you very much, Anthony. We're going to, as you say, we have 5 minutes each. That's going to be quite a challenge, but we'll kind of try to keep it to that because we want to make sure that this is as interactive as possible. And the title of this panel, which is the introductory panel, is incredibly broad. It's taking stock. And I'm not going to try in 5 minutes to touch on everything that we've been dealing with since the last forum 2 years ago. As Counsel mentioned, there's been a heck of a lot. But I was going to really touch on two key priorities. And one is basically around something which we see it right as a top priority in terms of our daily work and our policy work, which is the way in which, as regulators, we interact with our mainland counterparts. And the second, which I may not get to in time, is this question of front-loaded regulation, which is a style of regulation we have embraced and adopted and we've implemented over the last year or so, 18 months to a year. Now, actually, as I was thinking about this morning, and particularly the question of the way in which we interact with our mainland counterparts, the first thing to say is that it's not something which is of immediate direct relevance to the market. It's about our relationship with the mainland. But of course, indirectly it has profound implications, first thing. Second thing is, and this is really by way of an introduction, last week the Singapore Stock Exchange was in town on a kind of marketing trip. And we don't normally, as an organization, dignify remarks made by competitors with a response. But I thought today I'll make it an exception to that rule. I'm just reading from, I think, the FT report on this, which was basically saying Singapore officials have a clear pitch to Chinese companies, we are not China. I'm not sure if that is a pitch, really, but nevertheless. And then went on to say that, this is a quote from the Singapore exchange official who was here, "Is Hong Kong really the best place to list where China has some influence on the SFC?" he asked, referring to the Securities and Futures Commission. Now, as I say, I decided to ignore that temporarily, but then I changed my mind, because I think it actually goes straight into something which is serious and important. The reality, from our perspective, is that Hong Kong's value proposition, a large part of it at least, is that it is the IFC which connects the mainland to the world. It enables international participation in China with certainty and predictability based on Hong Kong's own system. And it also now enables the mainland to participate in Hong Kong and further afield. And there is no doubt that there is, and there should continue to be, a far greater overlap between expanding pools of international and mainland liquidity centered on Hong Kong. And of course, having said that, those opportunities, which are significant, do come with risks. And Hong Kong, in my view, has a unique ability to bridge both the common concerns of mainland authorities and mainland international investors to manage those risks. If you think about the risks, they are increasingly complex. In the past, the basic relationship between ourselves and the mainland authorities, particularly our counterpart, the CSRC, was around our focus on potential issues, conduct issues and others, in relation to H shares and red chips. In other words, companies that are listed here that are based in the mainland. And ultimately that involved a one-way street relationship with the mainland authorities where if we spotted a problem, we would be asking the mainland authorities to help us through an enforcement request or similar. Stock Connect was the game changer around all of that, because basically it was a system which, unlike previous interrelationships between the mainland capital markets and Hong Kong, involved no individual quotas, unlike the QFII schemes, and also involved orders being routed into each market from brokers in the other market, which basically meant that the degree of oversight and control each authority had over participants in its market lowered. That meant that at the time Stock Connect was launched in 2014, we had no choice but to put in place arrangements, MOUs, etc., which enabled us to cooperate a lot more closely with the CSRC to manage those risks. And those relationships, or those MOUs, were the basis on which we have now expanded that relationship. Now, the important point, getting back to the quote from Singapore, is that there is no way in which those relationships are in any way altering the basic approach that we take in Hong Kong to the way in which we regulate our market under Hong Kong law and under a process which is anchored in the Hong Kong rule of law. And in fact, the challenge really, and it's very interesting to be part of it, is that you do have two different systems, and you're trying to work out how, with greater capital market connectivity, those two systems can operate in a way where they remain distinct without any doubt, but there's a sufficient degree of understanding and cooperation that we can collectively manage common risks. That is a far cry from the notion, which I have to say right now is totally false, that in some way, or some sort of Yin Ke hate way, the SFC is effectively, as I think Singapore's, under the influence in some degree. We are not under the influence. It's actually a much more interesting, technical, and important story, is that we are spending a lot of time ensuring that the way in which we partner with the CSRC manage common risks, but recognizing the way in which we operate are under two different systems, very clearly. So I'll stop there, because I think we can develop that later on.
Thank you very much, Ashley. I can't resist just responding a little bit to what Ashley has said. You know, it's a lot of deja vu. I remember when I was doing the X shares in 1992 as a member of the listing committee, and we saw Vice Premier Jurumji, and he said that really, you know, what we want to do in listing Chinese companies in Hong Kong is to learn from the international practices that are in Hong Kong, so that, you know, our companies can grow and be part of the world. That I think remains the accent of all Chinese policies up to today, which is why today we have this makeup of the panel, because we have two members of the the securities markets who have been very instrumental in actually sort of building up the market since, in fact, Chinese shares listed in Hong Kong since 1993. And of course, we have the chair of the listing committee to deal with that. And then finally, of course, we have somebody from the buy side, and it's important, a member of the buy side. So I'm going to invite Ken to speak next. Ken is the chair of Goldman Sachs. Of course, Goldman Sachs has been at the forefront of a lot of the Chinese listings from the very beginning. And Ken.
Yeah, all the way back to China Mobile. And
absolutely, so. 1993.
Yeah, so. But thank you, Tony, and also thank you to the SFC for giving us the opportunity to speak here today on such an important and timely topic. And I'll emphasize important and timely. In my day job, I do sit on a lot of different panels around the region, and we really are in the middle of this. And I'll talk more about that, I'm sure, in the Q&A, but it's very, very tangible. The IPO backlog out there, and this may be coincidental to the discussion we're having, but is building very, very fast. We're at almost 2.5 times our normal backlog of IPOs, and the discussion about which markets and why are very, very timely. Since the first 8-share listing in 1993, Hong Kong's become Asia's premier financial center, and we love being part of that. It's played a very unique role in the world's gateway to China, and that's been discussed, and we'll get at that more. Clear and transparent regulations were a key factor that allowed Hong Kong to play that role. Today, 35 years on, Hong Kong now serves as a springboard for China's new going out era. And with China's economy becoming increasingly innovative, Hong Kong's financial sector faces new opportunities. Regulations that are more flexible and forward-looking can help businesses secure these opportunities. In this regard, let me share some observations. And to Ashley's point, I have a lot more than 5 minutes, so I've chopped it down to 2 topics. But as a market practitioner, I see that as my role on this panel today. As a market practitioner, let me comment on the Connect expansion and then also on the listing rules reform that are in front of us. So just starting with the Connect expansion, both stock and bond, Goldman Sachs has been a strong supporter, as Tony referenced, of these programs since their very inception, and it's just been a few years, but we really were there building out the pipes and helping to be ready on day one of the Shanghai Hong Kong Connect. The connectivity to the mainland is essential for Hong Kong's role as China's gateway, a role that we do not see changing anytime soon. This is a much debated topic, and it may come up in the Q&A. But at least for the next 5 to 10 years, we actually see much more symbiosis and synergy between the mainland markets and the Hong Kong markets than we do true outright competition. And trying to predict out more than 5 years is difficult. More than 10 years is a fool's errand. But I think we're pretty comfortable at the 5 to 10 year point. And the Connect schemes, as Ashley just referred to, are a critical component of that connectivity. And we do think they're off to a great start. I think volumes, both north and southbound, roughly doubled last year. And to deepen it, we understand that Hong Kong authorities are now planning to include ETFs and IPOs in the Stock Connects. We think this is a very good idea. Allowing mainland investors to participate in Hong Kong listings will also help attract more secondary listings from overseas firms to Hong Kong, another topic that will be, I'm sure, addressed today. And then going forward, Hong Kong should keep developing and advancing the Connect schemes, which will boost Hong Kong's financial competitiveness. Specifically, Hong Kong could consider adding more features to the Stock Connects, including block trades as well as new products such as A-share futures, and other derivatives. We've always seen the further building out of the Connect programs as a tremendous opportunity for Hong Kong, along with the continued evolution of the listing rules. So let me switch gears for a minute and just take 90 seconds on the listing rules, and I'm sure there'll be much more in the Q&A. We believe Hong Kong can ride the new economy wave by becoming the financing hub for innovative high-tech and biotech companies from China. And as I said earlier, there's much interest in this right now. These are real discussions in the bake-offs in the pitches that we're involved in, both on the biotech side and the tech innovative side. To that end, the recent proposal with the introduction of weighted voting rights is an important step. We agree that weighted voting rights should only be introduced with appropriate safeguards, and there's been much debate on that. And so in this regard, Hong Kong is well positioned. The city's existing protection for minority shareholders will, in our view, safeguard shareholders of all types, and we know there's some enhancements here specific for the weighted voting right companies of the future. So what else could we all do to attract more Chinese companies to Hong Kong without sacrificing shareholder protections? Let me offer 2 suggestions which may strike the right balance. First, allowing corporate shareholders to hold weighted voting rights. We know that's under discussion right now in a separate consultation. And second, not limiting the amount of equity that founders can hold at the time of an IPO. So we believe such measures will help ensure Hong Kong's listings regime is flexible, responsive to issuers' needs, but importantly, they do not weaken existing safeguards. So just to conclude, it's been a great 20 years for Hong Kong markets, and we believe the next 10 to 20 years will be as fruitful, and we welcome all of the dialogue that's going on now around all this important topic. So I will stop there, and I'll look forward to the Q&A.
Thank you very much,
Tony.
Ken. Well, next person I'm going to ask is Andrew, because Andrew is chair of the listing committee. He is between the regulator and the markets. He seeks to make the markets work. Andrew.
Thank you very much, Tony. So I'm not between a rock and a hard place in any way at all.
Sometimes people think you are.
Yeah. Deja vu all over again. Ladies and gentlemen, very nice to be here today. Maybe I can just share a very practical perspective on the listing reforms. There's 3 areas, as we know. There's the biotech companies, there's the weighted voting rights, and there's the ability to have secondary listings for innovative companies. A couple of reflections. I think the first one is, I think we all need to go in with our eyes very wide open into this new regime. There's been a big range of views about all those 3 areas. I think most people with strong views haven't changed their views during the process. And so we have to realize there are a lot of different views out there. I think the consultation paper, the proposals are a sensible balance which have gone out. But the work starts here. It's worth noting, for all the commentary, all the paper written, the length of the consultation paper, the actual depth of the 3 chapters isn't so great. They are relatively small chapters. That's not a criticism at all. What that means is guidance letters, the importance of submissions, the importance of clarity of decision making, the importance of the appeal mechanism for decision making, all of that becomes heightened. And it goes to questions as how to ensure one has the right composition of the listing committee, how does the stock exchange, how the SFC, how does the whole ecosystem ensure there's enough capability and knowledge of innovative technology and biotech business models, risks, intangible assets, all of these things, in order to make sure the market development aspect of the proposals works without putting at risk market quality and ensuring that the safeguards put in place actually work. So yes, there has to be balance, but I want to reassure everybody that there's a good understanding from me and the listing committee that there are concerns as to market quality and safeguards, and we take that very seriously. A couple of other points worth raising is maybe on the biotech one first. There's a lot of talk about weighted voting rights. My view would be actually the immediate story and the scale story is biotech. And there's a significant number of biotech companies looking to list in the world. When you analyze IPOs in the States and you look at the pipeline of Chinese companies coming, biotech is a large proportion. And actually the biotech industry does lend itself to a special chapter because there are certain thresholds, certain milestones, certain certifications, which from a regulator point of view, you can hang your hat on a bit more. And there are also certain things like a track record. One can actually look at the track record of developing products. One can get there. But the definition of biotech is actually, I think, quite broad. And one of the judgments will be compliance with the definition.
I'm sure there'll be lots of questions.
And how far it goes.
Yeah.
And also, I mean, they're called pre-revenue companies for a reason, which means, again, one has to go in with one's eyes open that there are risks associated with these. Some may not necessarily succeed. How does one look at the monitoring on an ongoing basis, delisting all of these things? So I just want to reinforce this point. The ecosystem relating to biotech and technology companies is so important. And the exchange, I understand, but certainly the listing committee is looking at access to biotech panels, high-tech capability on the listing committee. But what I would caution everybody is there's no such thing as a biotech expert. There are experts in particular aspects of a particular element of biotechnology. And I said we have to go in with our eyes very open on that. On weighted voting rights, I'll be brief. I think the safeguards are very, very important. And I was speaking earlier to another panelist who quite rightly said the best protection is one share, one vote. I think I would agree with that. But there is a market demand for weighted voting rights schemes. So the key is to have enough protection in the system, but certain things still require one man, one vote. And if you look at the criteria, in particular the high eligibility threshold, there's enough safeguards and rules in place that with sensible application, one can probably enable certain types of companies with the right features to list without allowing a race to the bottom or a deterioration of the market. But the proof of the pudding will be in the eating in terms of how the rules are applied. Finally, on the repatriation issue, Tony, I think, the secondary listing, again, high eligibility threshold, safeguards in place where bulk of trading comes to Hong Kong. Again, the opportunity to be fairly selective, an opportunity for submissions to be made and then considered. So I think what you can take from this is the journey is now starting as opposed to having stopped. And now that the new rules are likely to come in, that very, very eyes open, let's have a balanced approach to how we apply the rules, there's real recognition of that. And just a final point is anybody hearing this feels stimulated by the listing committee, there's a nomination process going on at the moment.
Absolutely. It's no easy job too. I'm going to ask next Yin Ke to speak. Now, Yin Ke is the chair of CITIC International, which of course is the international window of CITIC Securities. CITIC Securities is one of the earliest security firms in China. Under the CITIC International, of course, is CLSA, whom we all know. So I'm going to invite Yin Ke now to speak.
Okay, thank you, Tony. Thank you, SFC, give the good opportunity for me to share my personal view. Yes, you know, I have actively involved with both Hong Kong and the mainland market for almost 25 years. And I remember we call the help for the Hong Kong regulators went back to 1990 when we set up a Shenzhen Stock Exchange. It's a very early stage. We learned from the journey. During my job, there are two questions that I always get asked. Firstly, what's the relationship between the Hong Kong and the mainland in capital markets? And then secondly, what the most important thing mainland company want from capital markets in Hong Kong? And you know, the first question is too big. It's a big one. So I'm going to use, I always use the metaphor to help with my answer. Imagine the mainland and the Hong Kong markets being a door and a window to a house. They are structurally different, and they have different role to play. That means one does not simply to replace the other. So when the door sometimes closed, the window often is opened. So if I relate this to financial markets back to the early of the 2000s, when China commercial bank reform was at a very critical point, the Asian market was not open to those banks, but Hong Kong was open to them. So as a result, China Construction Bank and the Bank of the Communications successfully listed in Hong Kong in 2005. So I believe without this key and the successful step, there would not be the successful journey of the China financial reform soon after. So that contributions made by Hong Kong to mainland economy definitely, I think definitely should be rewarded and really cannot be overemphasized. So looking ahead, like the relation door and the window, I have confidence the relationship between two markets will remain solid, but only grow stronger so long as we continue to do what we do the best and avoid big mistakes. So for the second question, I always remember the answer one executive from state-owned company once he gives me. So let me quote his words. He said, "When I look back, the single biggest benefit of going public in Hong Kong was not having the access to more foreign capital, was not the ability to expand our overseas business. It was the strong regulatory and compliance system that forced our minds on better corporate governance. We are now much more transparent and better at meeting the needs of our shareholders." So interestingly, it is not the view of just one executive, but many executives I speak to. So we can talk about many Hong Kong very unique advantages for mainland companies, like we are the freest economy. Number two, the strong track record of the reform, like Tony mentioned, the Hitchner regime back to 1992. Yeah, we have a strong track record on this area. Number three, investment community here that truly understand China. Number four, we have a very strong, like Ashley mentioned, the stock connect between two markets. We are recently very good progress on our own reform, like WVR. Yeah, it is essential, but I do think it is important not to forget the core value of Hong Kong capital markets for mainland corporates. That would be, I personally think, would be the resolutions around corporate governance. So we would all agree mainland China will be the largest source of the new listings and the capital flows for Hong Kong in the years to come. So in order to drive this source, I believe the key strategy, if I talk about my personal recommendation, is to keep or even raise the corporate governance standards here in Hong Kong with such efforts on the place. So I believe we can ensure our top competitiveness. This just my personal view. Yeah. Thank you.
Thank you very much, Yin Ke. Well, finally, we come to Graham, because Graham is the chair of the Hong Kong Investment Funds Association. So he comes from, really represents investors. And so I'd like him to speak about his expectations of the regulatory system in Hong Kong.
Thank you. Well, I feel a bit like David and Goliath here, surrounded by three heavyweight sell-side gentlemen, but I'll try to do my best to represent the views
but you're the customer.
Of the buy side.
You're the customer.
How
Very
things
important.
have changed. Look, there is no doubt that Hong Kong has a very strong reputation as a stable, conservative, and transparent legal and regulatory regime. It has, at least for now, an independent judiciary that keeps pace with commercial and regulatory developments, and Hong Kong has a very sophisticated and well-respected arbitration centre. The SFC and the government here is not afraid of taking enforcement action, as evidenced by some recent cases in the press for a Swiss bank and a German bank at their cost. And it keeps up with reporting and disclosure standards as evidenced by recent OTC derivatives reporting coming down the pipe. The SFC, to its credit, consistently seeks to ensure that regulation keeps pace with IOSCO developments and international standards and recommendations. And frankly, over the last 6 to 12 months, there has been a whole raft of consultations that the industry has been engaged with. I think overall, the manager-in-charge regime has been successful. It has forced a lot of financial institutions to get their corporate governance in order, and it has enhanced accountability for individuals. I'm not sure that everybody who is a manager in charge relished the thought of doing an exam for the first time in 20 years in order to get qualified as an RO, but that's a consequence, and a good one, of that regime. Clearly there have been enhancements to the fund manager code of conduct and the code of conduct for licensed companies. And as we all know, we're in the midst of a revamp of the unit trust code, and there have been consultations on online distributions and OTC derivatives trading. The government in Hong Kong is doing all it can to maintain Hong Kong's status as an international financial centre, and part of that is trying to encourage Hong Kong to be a fund domicile. And a lot of work has been done on open-end investment companies, and I understand that further work will be done on beefing up and modernising the limited partnership legislation to encourage more private equity business in the territory. We've talked a lot about already weighted voting rights, so I'll leave that for now. So I think all that is very positive, and a lot of kudos needs to be given to the government and the SFC for that. However, I guess on a more constructive angle, I do feel that Hong Kong will fall behind other financial centres if it does not keep up with innovation. And Mr. Chan, in his opening address, mentioned the fact that Hong Kong is very much aware of that, and it needs to maintain its competitive edge, particularly when you see what's going on in the technological space north of the border, admittedly in a very different regulatory and legal environment. But I think it's fair to say, as Ashley perhaps mentioned earlier, that there are other financial centres that are perhaps arguably moving quicker than Hong Kong. Australia and Singapore spring to mind, whereby Hong Kong, I think, has the perception at least of adopting a much more conservative approach. And I think this is evidenced perhaps in the fintech arena. A huge amount has been discussed and talked about fintech, regtech, techfin. It's great that the SFC has established a fintech sandbox regulatory regime, but the cynical view would be that this was only after the MAS had established and offered a full package of light touch regulation alongside some state funding, which is particularly appealing to startups who may be capital light. So I think it's going in the right direction, but perhaps we need to be a bit more ambitious in our aspirations. I mentioned the fact that Hong Kong is trying to attract itself as a fund domicile, which is positive, but again, there needs to be interaction between the IRD and the other regulatory agencies to ensure that these structures are attractive. One example is the open-end investment company. I'm not sure that it's as tax attractive to hedge funds and private equity houses as a result of Hong Kong's more conservative approach. I mentioned earlier about the unit trust revamp. Again, it's great that this is taking place because it's been a long time since it was reviewed. But I think we need to or the SFC needs to recognise that the majority of people sitting in this room represent international houses. Hong Kong is but one territory in which they do business. And there is a perception, at least, within head offices that Hong Kong, coupled with perhaps Switzerland, is probably one of the more challenging regulators to deal with from a business perspective. And this may be illustrated by the fact that the SFC has taken a commitment approach rather than a value at risk approach in its analysis of derivative instruments used in investment funds, which is probably a little bit at odds with the UCITS regime. I don't want to be too negative. I think the SFC is doing a lot, and I think it recognises that we are now living in a digital age. Technology is disrupting the industry, as we all know. Frankly, we're all grappling with it, but I think we just need to recognise that we can do more. So what then do I think Hong Kong can do to improve its competitive edge? My own view is that the SFC needs to balance, and this was mentioned by Mr. Chan as well in his opening address, we need to balance investor protection with market development. Now, clearly the SFC needs to focus on investor protection. That is consistent with any investment manager's fiduciary obligations towards its clients. But my own view is that perhaps it has focused too much on investor protection since the 2008 Lehman money bond crisis, and it needs to turn its attention to maybe some greater market development. As I would say this, coming from BlackRock, I think this is well illustrated by its views on ETFs. The SFC recently issued a paper in January, and it contained a lot of interesting and good work. But from that, I learned that over 70% of the ETF market in Hong Kong are either focused on Hong Kong securities or Chinese securities. Now, to me, that does not offer a particularly healthy environment because there's a lack of choice for investors if they want to invest in Hong Kong-listed ETFs. So I think the SFC needs to think about launching wrap products to allow investors a more diverse range of ETF products as the growing ETF market develops. I also think that the age-old issue of suitability assessment needs to be looked at. Distributors are clearly obviously always focused on taking responsibility for suitability, but perhaps we need to think about whether a product manufacturer can take more ownership of apportioning a risk assessment to a particular product, which a distributor can rely on. I think the government needs to play a better role, or rather a larger role, in policy development. I think the legislative framework, the SFO from 2003, is complicated, and it's been amended over the course of years, and so it's fairly piecemeal. I think the FSTB should ensure better coordination between the regulatory agencies in Hong Kong and to push the legislative amendments through LegCo. We live in a very connected world, and clearly regulators are talking to each other much more. And I know the SFC are very active on IOSCO, and there is a huge amount of regulatory engagement, and we need to make sure that the SFC continues with that, particularly with this, the CSRC, but also with all other global regulators. So I guess in summary, I would say the SFC is doing a good job in keeping pace with regulatory change, but I would like to see some more innovation that reflects how the industry is changing and reacting to technological change.
Thank you very much, Graham. Well, whilst I'm waiting for the questions from the members attending this, perhaps I'll just start off with a few questions. And I'll start off with Ashley, because Ashley, you did mention that certain people tries to put forward a theory that the SFC is somehow under the influence of the Chinese regulatory agents or the government. But of course, that perception, in a sense, is assisted, you might say, by the fact that maybe 80% of our companies are Chinese companies. Many of our companies now operate in China, and there are SOEs as well as, of course, sort of non-SOE companies listed in Hong Kong. How do you deal with that problem where, in fact, you have companies whose management are away from Hong Kong, whose businesses are away from Hong Kong? When I started on X-Shares, they're all X-Share companies which are SOEs. And SOEs are relatively easy to deal with. Now, most of the companies now listed in the stock exchange are non-SOEs. How do you grapple with the problem? And how do you then really assert your independence as a regulator?
Well, I mean, in terms of asserting independence, obviously the laws we apply and the supervisory approach we apply is entirely based on Hong Kong law and regulation. It's not there's no impact or influence around mainland law and regulations. That's really relatively straightforward. But the more complex part of this question is that, having said that, the different flavors of connectivity between the mainland and Hong Kong, as I mentioned earlier, is far, far more complex than it was in the days of where the connection was 8 shares. So to just give you one example, through Stock Connect, any investor in the world can trade the A-share market through a Hong Kong broker. So if you look at it from the mainland authorities' perspective, if they're concerned about having a sufficient grip, or sort of grip that they're used to in relation to their domestic market, that blows quite a big hole through that. Now, it was a deliberate decision to enable the world to participate in the A-share market. We've now seen Bond Connect. And as you mentioned in the opening, I think actually, and Ken mentioned, we are all working very, very hard on the infrastructure, particularly regulatory infrastructure, to enable Connect to expand in a range of products and such like. But the important point is if you think about international investors interacting in the mainland authorities become as dependent on their ability to source information and regulatory assistance from us as we do from them. And that basically means that there is a convergence of interest or an alignment of views about risks and interdependence. And that in turn means that A, we have no choice but to work closer together, which is a good thing, because that's how we manage the risks. And secondly, in working together, we understand a lot better how each of us operate in each other's jurisdictions and how we're able to manage the differences without compromising the way in which we operate, certainly in Hong Kong. And when it comes to just your question about how do we basically deal with private companies, non-SOEs listed in Hong Kong, yes, the risks associated with private companies are greater. There's no doubt, because they do not have, certainly don't have explicit state backing. Some may have implicit state backing, but that's a different matter. But what it boils down to is a greater level of detail and understanding as to how we can seek regulatory assistance on the ground in the mainland in terms of, from an enforcement perspective, audit information or bank records, etc. And that is developing. And it's exactly the same way in which we would deal bilaterally with the SEC, with the FCA, and other regulators. There's no philosophic difference between any of that. But but it's a moving story. And the final point I'd make is that our view is that because of this alignment of interests and our need to deal together with the risks arising from cross-border flows, recognizing the opportunities, the ability of both of us to grow those flows by expanding the scope of Stock Connect and other connectivities is very, very dependent on our ability to strike arrangements with the CSRC that preserves the way in which we both operate under our different systems, but allows us to manage the increased risks of increased flows. And that's kind of obvious, really, but it's a long, long way away from what the Singapore Stock Exchange was trying to, give an impression, which was very, very, I don't think it was very adult, personally, which was, which is in some rather strange way, we're kind of under some sort of influence. It's just not the case. It's a much more straightforward, it's an arm's length relationship, but at the same time, it's quite intense, and it has to be, given where we are.
I see that Yin Ke is nodding. Do you see that that there is indeed an impression that Hong Kong is under the influence of the Chinese authorities?
Yeah, I think the one thing is very simple, is more communications and more independence. Even you think there's a two-way, but I think it's one way. More communication with the regulator, my home regulators, and I found that they maybe lack the knowledge. It's not critical to my home regulator, but sometimes they have no common sense and knowledge about the global practice. So more communications, they can more understand what you want to do and how you deal with some challenges. And for example, we acquire CLSA. That's totally different culture with our SOE culture. So how we deal with that? And I set up a very long-term communication program. The center people, we are staff in the Philippines, in India, they have no idea about the SOE in Beijing, our headquarters. What's the culture of how to put the butter of the elevator, which flow you can go, which flow, yes, be careful of that. But from this scratch, and he understand the culture. So I suggest, like the forum, SFC here, or other forum, we can invite and the CRSC colleagues or some counterparties join us, show their views and share their views, and more communications and influence. Of course, we do the global practice, we do the global business, definitely influence. But how we keep it more independent and give independence view. So like a CSA forum, the critical from many counterparties like China SOE companies say, hey, you cannot say that because you are clients. But I say this independent forum. The views on this forum should be keep independence. So I think we can do that, both more communications and more independence, but we tackle this sort of influence. Yeah.
I do think Singapore's comment is a bit ingenious, quite frankly. I mean, there is no doubt, as we all know, Hong Kong's future will be dependent on its relationship with mainland China. And it goes to my point that I made earlier about the importance, and what Hong Kong is very good at, of transparency. And, we all spend a lot of time in developing relationships with businesses in mainland China, and it's just the same with respect to the regulatory environment. Sometimes it's not easy, but transparency and time taken to embody those relationships is going to be to the benefit of both Hong Kong and to mainland China.
As an international intermediary, Ken, what are your views on this? I mean, is there this perception or that Hong Kong is under the influence of the Chinese authorities in terms of its regulation of the markets?
Well, I think both. I'm probably just parroting back Ashley and Yin Ke.
Yeah.
I think collaboration and coordination between the regulators is incredibly important.
Right.
We think it's quite good, but it will need to continue to get better and better, to Ashley's point, as we build out these big markets. The spin of the SGX sounds a little bit offensive to me. The connotations around that. So we don't see that or feel that.
It may have been somebody relatively junior, as they have said. Anyway, I teach in the US, and I don't hear that perception.
Yeah,
anyway.
I'll give you one anecdote. I arrived here about 5 years ago, and smack into a discussion that I'd never heard before, being sort of a provincial American working out of the New York office for 22 years, which people started asking me, including on a panel. How do you see it playing out, the Singaporean financial hub versus the Hong Kong financial hub? I wasn't even familiar with that conversation from 8,000 miles away. And just for the reason Yin Ke said around China's importance to Hong Kong and what we've seen, I think that debate is largely over. I mean, if you just look at the number of IPOs that we and all of our competitors do here in Hong Kong relative to what's occurred on, I love Singapore, but I mean, as a financial hub, this is where the action's at.
Absolutely. Now, I've got 4 questions on weighted voting rights from the audience. but I'm gonna. Well, first of all, before I go to that, because there's one burning question that you mentioned, Ken, about biotech companies, because it's very, very hard to first of all, define it, and secondly, to see at what stage of its development of its technology that will make it suitable for listing. Now, the FS, in fact, has said that in Hong Kong on green bonds, he's going to have a certification authority. That's very helpful, actually. Now, in terms of biotech, I mean, what kind of technological support would you have on a listing committee? I mean, you look at the members of it, I think they're not tech people, they're certainly not biotech people, right? So how are you going to deal with that?
As I say, it's a whole ecosystem. One can apply the question to the listing committee, the division, the exchange, sponsors, lawyers, accountants on this whole new economy story. But what we're doing is we're looking, I don't control the composition. The composition of listing committee is There's a nomination committee run by Stock Exchange.
I'm not suggesting you
SFC.
should change the composition.
No, I'm not.
No.
But I
Yeah,
think
yeah,
it's relevant.
yeah,
I think it's relevant.
yeah.
Everyone is appointed on an annual basis. So there's 24 people on that
Right,
committee.
right.
Getting representatives of platform companies, innovative companies, and players, be it scientists, professors, or investors in the biotech sector, is important. And there's a process ongoing at the moment looking at candidates. And a number of people have put their name forward. That's just one step. The second step is how can people have access to biotech capability? And I think what's very likely is a form of panel of biotech experts would be
Some
set
advisory
up.
committee.
Advisory panel.
Yeah,
That's what
yeah.
we're looking at for the benefit of the committee itself. And I would envisage that the exchange itself would also be looking at its own in-house capability on that as well. People are out there, but as I said, I use this word of caution, that it's not a silver bullet, there's the biotech expert. It is such a broad area. The key is to have enough breadth to understand, quite frankly, the right people to bring in at the right time. And I think it's very important that people realize this is recognized now. And as I said at the beginning, one goes in with one's eyes open. Going back to accreditation, Anthony, I think it's relatively straightforward because if you look at the proposals, there's international accreditation bodies, competent authorities, and there's clearly defined stages.
Like the FDA and places
there's
like
clearly
that, yeah.
defined stages. And I think everybody's recognized there's certain things such as round tripping of initial ideas into a product, more than once, that type of thing. I think we again have our eyes open on a lot of this stuff. But there is the attraction of it is measurable and defined milestones accepted. So I don't put people's mind at rest at that. But it is a big step forward in Hong Kong. And there are similarities to an extent with the mining chapter when that came in. And if you look at the mining chapter, there are sort of advisory panels on mining. There are mining experts available to exchange and the committee and other things.
Because I
Tony,
hear
can I
from the
jump in on
markets,
this
Ken,
biotech?
that biotech companies tend to be very interested in the space that you've just mentioned.
Yeah.
Far more interest than WVR.
Tony, but just before just going to Ken, just to wrap up, I think you've got two things. One is enough understanding of the product and the commercial viability. The second one is what the business model looks like. And an area I've been raising, and I know a lot of people are looking at, is, what is the feature of biotech and innovative companies? They tend to be very intangible asset heavy. And the valuation of intangible assets, the valuation of balance sheets, which are going to prospectus, is going to be very important. And I think the SFC issued a very good guidance letter back in May, actually, which was actually in the context of valuation on transactions and how boards and directors look at valuations ahead of doing deals. The same rigor needs to apply to valuations of intangible assets. And at the moment, there's a big difference between how a tangible asset under rules and regulations is valued and the hurdle and barrier of entry for a value in, let's say, property or plant and equipment, and the valuation of, let's say, a brand, a valuation of data, a valuation of goodwill. And I think this is a very practical thing which we'll have to look at very carefully.
I'd like the members of the other panel to deal with this too, because I think this is a very important subject for the months ahead.
I'd love to weigh in here just because my 22 years in New York, I was a healthcare banker. In fact, the back half of that tenure, I ran the global healthcare business before coming into this role. And so I was there sort of at the germination of biotech. And when I read last night again the biotech section, it was very nostalgic because in 1995, 1996, internally at Goldman Sachs, through our committee structures, we dealt with these exact same issues. We had never underwritten a non-cash flow generative company, let alone a biotech company with very even limited data. And although some of the grappling with the criteria are different in this consultation paper than what we dealt with, the spirit of it and how we're trying to get at it was exactly the same. I would just add, we're 22 years on. This is a much bigger, much more important industry with, quite frankly, more markers along the way, many of them considered in the consultation paper to deal with this. And I'm completely supportive, and Goldman's completely supportive of us doing this around innovative companies and biotech specifically. But I've already heard, one of the things we'll need to grapple with in Hong Kong is, will Hong Kong, collectively, will we have the courage to stay with it? Because 30 to 40% of these biotech companies will fail, and they may fail spectacularly. And on the innovative side in general, we will have spectacular successes. We will have future 10 cents across tech, across biotech, going down the track that Hong Kong is going here. But there will be front page headlines of really spectacular implosions. And that's the nature of dealing with the bleeding edge innovation and dealing with science specifically around biotech. And
Absolutely. That is the very question that Graham raised. This is balancing protection with innovation. Do you think that biotech might be a step too far in this case?
In short, no. I think as long as there are adequate protections, then we should be okay. But I guess the point I'll make is that, clearly it's important to establish Hong Kong as an innovative centre, and I think the biotech rules go, a long way to doing that. We have to go in there with our eyes open and recognise, as you say, that there will be some great successes and there will be some great failures. But, it's important that we remain an attractive listing venue, but ultimately that shouldn't be at the expense of the integrity of the market, which underpins effectively its sustainability. But I'm very optimistic about the success of this, because I think it really does encapsulate and embodies Hong Kong's get up and go and can-do attitude, and innovation is clearly part of that. So I'm all for it.
Some of the sort of investor protection issues involved in that might be in terms of disclosure, in terms of investor education, and perhaps some front end. Actually, you've been talking about using the front end aspect of listing in that. Do you envisage that biotech might be an area where some sort of front end intervention might be necessary in terms of the regime that you have on the securities markets listing rules?
Yeah, potentially it could be. The whole theory around front-ending, particularly in relation to IPOs, was that we do actually have the tools to intervene directly if we feel that there is basically a public interest issue at stake. And we have done that over the last few months. It's a little bit fluid in a sense because, as Andrew says, the listing committee certainly is now fully aware of the challenge in front of it. And so, there is a sort of grey area between the degree to which we decide to intervene from a statutory perspective. And incidentally, one of the reasons we've basically come to the front line in relation to that is in the past, we still intervened, but it was behind the scenes, which from my perspective, and I think the market's perspective, was unsatisfactory. So now we basically, we interact with the market by, when we do intervene, by making clear what our point is, and we reason that point, and if the company involved wants to challenge us, it can, and ultimately it can be appealed, the issue can be appealed to an outside body, which is the appeals tribunal. So it's putting good process in place of a behind-the-scenes, rather Yin Ke sort of approach. So that's what we've been, now that could happen, but I think Andrew's made some very, very important points, is that, what Hong Kong took on in relation to weighted voting rights, biotech, and secondary listings was not easy. Now, you could simply decide to throw the baby out with the bathwater and say, it's all disclosure. As long as you disclose, anything can list. Now, there are sort of those who may say that is a path which you can go down. There's a degree of logic behind it. It actually doesn't happen in any significant market in the world. There are always criteria around listing and other forms of corporate activity. Now, what Hong Kong had to do, what it has done, and it's about to implement, subject to the current consultation and feedback to that, is basically the world's first set of rules for weighted voting rights, and there's the biotech pre-revenue, but particularly on the weighted voting rights side. The US, which is the major competitor in this space of around governance of tech companies, doesn't actually have any rules. It's a rules-free situation there. So it has the luxury, effectively, of saying, well, actually, this is something which has grown up in our market. It's largely a sort of, it's in part a kind of commercial negotiation between the sell side, the company, the buy side, and what they sort of feel comfortable with in relation to a particular company. Here, we knew that wasn't going to happen. The scene is rather different. We do not have class action litigation in Hong Kong. Probably a good thing overall, potentially, but in this area, maybe not. So it's a different scene. So we had to construct the world's first rules. Now, that in itself is very difficult because balancing the safeguards against obviously the objective to ensure that this is successful and introduces interesting companies that Graham and others want to invest in Hong Kong, that's quite difficult. And we hope we've got the balance about right. But I think Andrew made a very good point, which is from the listing committee's perspective, the work just starts once the rules are in place. Because applying these rules in practice is not going to be straightforward. You have a number of filters as to which companies, how companies would qualify, and those filters themselves do require judgment to be. So going forwards, I do see that clearly formally, yes, the SFC could intervene up front and directly in cases where we feel that there is a public interest or similar concern. But I think actually I'm quite optimistic that under Andrew's leadership, the listing committee itself is starting to think very, very hard about the quite difficult task in front of it of administering these world first rules.
You've just started this policy panel. I've seen the MOU just signed between the SFC and the stock exchange on this one. Would that help the process?
Actually, I might defer to Ashley on this one.
Well, I hope so. I hope so,
yes.
but
Yeah.
the reality is, yes, a policy panel is being set up, which is an opportunity periodically for all of those who are policymakers, basically, to get together and discuss current. But actually, you know, it rather depends on the people who are in place at any particular time, as distinct from the formalities of meetings. So, from my perspective, the more we're able to interact with Andrew and his vice chairs and other members of the listing committee, the more I'm able to interact with, I suppose, my counterpart at the exchange, which would be Charles Lee, and and the chairs and such like. That is all to the good. So, I think it helps. I don't think it's something which is absolutely essential, i.e. without that we'd be in a mess, because I think our communication over time is getting better, actually. And I think part of that is to do with the fact, again, going back to the reality that, don't underestimate how difficult this stuff is. I mean, Andrew's pointed out some issues around biotech. It is hard. And the judgment calls that the listing committee is going to have to make are going to be difficult. And I also, just one point Andrew did mention, is I do think we need to sort out the way in which listing committee decisions can be appealed or reviewed into a process that is far more robust than the current process.
Right. Indeed. So I've got quite a number of questions now, which I will distill into two sets. Well, the first set, as you would imagine, relates to weighted voting rights. I have one philosophical question and one operational question. The philosophical question is this. Is Hong Kong rising to global international standards by adopting WVR, or is it sacrificing investor protection for the sake of enhancing its attractiveness? That's a philosophical question. Now, in terms of the operational question, there's quite a number of questions in terms of secondary listings. Would you be accepting sort of depository receipts, or you just have shares, or you're open to all kinds of potential structures? So perhaps to you first.
Okay.
Yeah.
Thanks, Anthony. The good thing about being listing committee chairman is it's a limited number of terms you can do. I think that first question, the philosophical one, actually, I think the challenge is to make sure that the 2 points are not mutually exclusive. I really recognize the legitimate concern about deterioration in quality because of weighted. I really do understand it. But I think there's a very, very compelling market competitiveness story on weighted voting rights. So I think that is doable. But the proof of the pudding will be in the eating. If I could raise a slightly controversial subject, which hasn't been touched on, is actually corporate weighted voting rights. And people may not have seen, but in the consultation paper, there's a statement of intent. There would be a consultation on corporate weighted voting rights later. There's a lot of debate recently about that. On balance, probably making it distinct, because there is a philosophical difference between founder-based weighted voting rights and corporate ones. But there is an important debate to be had on corporate weighting voting rights, because there's a lot of commentary in the market that this is very important, but there's also, I think, probably a widespread acceptance that one doesn't want it to get into widespread nature of weighted voting rights. How does one square off that? So I think the consultation on corporate weighted voting rights is very important. Spin-offs of organizations which already have founder-weighted voting rights is a fair question. Another fair question is, what is the definition of innovative company to benefit from that? And what happens if companies are changing from old economy to new economy? So I think getting these issues on the table on corporate weighting voting rights is very, very important to that philosophical question. In terms of the detail on the type of instruments which come secondary, again, I'd have to defer a bit to the SFC and the stock exchange on that. Largely, it's in the context of basically secondary trading of equity shares.
Is it too early, actually, for the SFC to put forward its views on weighted voting rights at this stage, or you want to wait till the consultation period is done? I'm not going to force you, therefore, you can take the Fifth Amendment.
No. I think just a few things. I'll try to keep it simple. I think we do recognise, and this is both voices from the sell side. The sell side voice tends to be quite louder than the buy side voice, for reasons I won't go into, I think. But anyway, it does. I think the buy side has been saying to us quite consistently that in the areas that they're interested in, which is basically the large caps, the variety of interesting companies to list to invest in has just been too narrow. There's just not enough. And many of them simply say to us, well, look at it, it's basically, banks, natural resources companies, and one or two big techs. And, frankly, they want more of the latter. Second point is that there is a very useful debate about the pros and cons of weighted voting rights. Ultimately, the arguments on each side kind of tend to neutralize each other. I was at an event last week, and I just picked up an FT article, which is about this concern of so many companies, particularly in the US and now increasingly in Europe, staying private for longer. The unicorn thing. And one of the issues it was pointing out is that private companies, I've got the article here, this is in the US, private companies invest twice at the rate of quoted ones. Actually productive investments themselves in their growing business, etc. And that was ascribed to, in this article, and it's just one dimension of the debate, to whether or not a focus on shareholder value is something that is driving, very short-term shareholder value, is driving underinvestment in public companies. Now, I'm not going to say whether that's right or wrong, but it just means that the range of opinions around this are very broad, and there's a lot of validity in all of it. Now, yes, the best safeguard is one share, one vote. There's no doubt about that from an investor protection perspective. But we recognize that given all of these arguments, given the ask from the buy side, which was effectively twofold, we want to have one share, one vote. That was one sort of clear message from buy side. However, we want to be able to invest in these companies in Hong Kong. And we were dealing with what was a real competitive threat, which was the US, which incidentally, as I mentioned, has no rules around weighted voting rights. So therefore, the challenge was, can you construct a set of rules that achieves a balance between shareholder protection, weighted voting rights, or the ability for companies to list with them, and also to ensure that weighted voting rights do not become widespread, which goes to this debate about corporates themselves having weighted voting rights in spun-off subsidiaries, etc., which is a very difficult topic because the philosophy behind that starts to stray from the basic philosophy around weighted voting rights held by individuals, effectively.
Can I give you my take on this? So,
go ahead.
Look, and obviously it's the hottest topic, but in this philosophical versus practical, both are fact-based arguments, and both are right. I think Andrew said it well, paraphrasing, there needs to be a nexus of how we get to where we need to get to. But as an anecdote, SGX is not the only exchange that markets here. I attended a event, small group, probably 50, 60 senior buy-side, sell-side, with the CEO of NASDAQ just before Chinese New Year. And she gave a full-throated defense, and she was being under quite a bit of pressure from two buy-siders about one share, one vote, but a full-throated defense of weighted voting rights. And I'm not here to repeat her arguments. Ashley actually got at a couple of them, but to make the comment that she was making a full-throated defense. They're not going back, right? And so, on a practical side, this is the commercial reality that Hong Kong is dealing with and how you manage that tension. And it's very, very real because the backlog is building. And I can tell you as a practitioner, I was in 2 pitches last week, one biotech, one tech. This took up an inordinate amount of the time that we never would have seen a year or two ago. To Hong Kong's benefit, wanting to understand where Hong Kong's really going here. And I'll give you one anecdote also on the corporate side. By our research, there were 27 Chinese weighted voting right issuers in the US since 2014. 13, so basically half of those had corporate.
Yeah.
So, Hong Kong has to make these decisions. Are we willing to take half of the current and potential future universe out? How do we compete for that other half? These are very, very difficult issues that are being grappled with in the consultation paper.
I think Ken, I'm sorry.
Yeah, but you go ahead. Because I'd like to Graham really to have the last word on this, because he's going to buy these things or not buy them, or his clients and his members. So Ken, Andrew, go ahead, and then Graham, because we've more or less run out of time.
Well, in that case, it's very important I say it, if you're going to buy them, Graham. Just to reinforce Ken's point, the philosophical debate about weighting voting rights when it's founders, it is exactly that philosophical. When you get into corporate weighting voting rights, let's call it out for what it is. It is a competitive Hong Kong's competitive position story debate. And I know there are organizations looking to use the corporate weighting voting right route. I think it's important to get it out in the open, have a good debate about it, and conclude on it. But it is a different type of debate, as opposed to the initial weighting.
Graham, representing investors.
Yeah, representing, I guess, our view. Our view is that voting is one of the fundamental rights of shareholders, period. However, and this is, I guess, probably talking from a more personal context, we recognize the commercial expediency of what is happening in the market. And if Hong Kong doesn't move, then frankly, it's going to lose out to other venues. So I think it's incumbent on all of us, bearing in mind that the train has left the station, so to speak, that we are fully engaged in ensuring that the consultation is well thought out and the rules that come out take into account all the concerns that we have of protecting the rights of investors. Because if you're managing a passive fund and you don't have any vote, then it's difficult because selling's not an option. But I think practically speaking, it's up to us to make it work. So let's do that and be optimistic about the future.
It was a wonderful note to end on. And the next set of questions, in fact, no time to deal with it. I can tell you what they are, which is, in fact, since after 10 years of the global financial crisis, is Hong Kong's regulatory system there yet? Now, I'm going to leave all of you to listen to the next 4 panels so that you can make up your own mind at the end of the day. Would you please join me in thanking members of the panel?
Thank you very much.
Thank you.